Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, September the 10th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, and on top of that, in these daily market commentaries, I talk about my market analysis and how that is impacted by that economic and geopolitical environment. We also go a little bit further and talk about some option strategies I'm implementing or taking off on a daily basis based on some of those market profiles that I've come up with, or some guidelines, I should say, around option strategies in order to implement those into our portfolios. I drill down on those in webinars like I'm doing today on the long strangle, so please check that out. We'll talk about that a little bit here later on when we get into my specific trades. But first off, let's talk about the economic data and see how that's impacting the overall markets with some market analysis. We've gotten across the pond, not really a whole lot to see there. We did get a refinancing rate that was pretty close to unchanged from what we were expecting. And then here in the United States, moving back here, we talked about PPI, and that's Producer Price Index. That's where we're seeing prices paid for different products that we are, as consumers, going to be purchasing. Well, we got the core, which strips out food and energy, coming in a little bit higher than expected at 0.4%. And then we got it when you add back in that food and energy PPI straight line number, coming in at 0.3%, expected to be 0.2. So both of those a little bit higher, showing inflation, which is generally a good thing because that shows that there is some demand for these goods. And when we have demand, people buying, those prices will start moving up to an equilibrium. If you go back to Econ 101, and it's guns and butters is what my econ teacher would always talk about. But that has to do with price elasticity and demand. As demand starts increasing and you have a limited supply, that drives prices higher. All right, so let's talk about the wholesale inventories that came in at negative 0.3%, expected to be a negative 0.1. Now remember, inventories, we would expect if they're losing inventories, that means they're moving those goods. Generally speaking, it's kind of a wanky number, to be quite honest. But when it shows up with that PPI and the prices moving higher, one could assume that there is actually demand for those inventories rather than just a manufacturer slowing down on production and moving inventory. That's a little bit different beast, right? That's slowing of the economy, and they're just trying to move out old inventory. What we're seeing here is a relative ramp up in manufacturing, and they're able to move those inventories, as we've seen through the ISM numbers as well. All right, so natural gas storages coming in a little bit higher than expected at 70 billion cubic feet, expected to be a 68 billion cubic feet. Crude oil inventories, a build of 2 million barrels, expected to be a drawdown of 3.1 million barrels. Now remember, that drawdown last week was due to the fact that we had a couple of hurricanes and the offshore drilling had to shut down. So that number came in lower than expected, looking like it was a draw, but it was really the fact that there wasn't a supply coming into the markets. All right, so today we're seeing the crude oil inventories as a build, kind of reflective of what we've been talking about, that lack of demand. So we're starting to see some crude oils build, seeing a little bit more weakness today in crude oil, but only down by a couple of pennies here or a quarter or so. Well, one of the things we've talked about here is this price is going to be driven by weakness in the dollar, and we were seeing some strength in this yesterday and today, and that is due to the fact that we were seeing a weaker dollar. Now that's giving gold a push to the upside because it's a dollar denominated product, right? As we see a weaker dollar, we should expect crude oil and actually gold to start moving higher. Today we're seeing gold move back above that 9-day simple moving average, which shows short-term bullishness. Also, finally getting this 50-day moving average kind of crossing over what we talked about is this 1923 area, which is the previous all-time high back in 2008 and 9. All right. Bonds are coming off just a little bit, but the fact of the matter is they aren't going to go anywhere. I'm still expecting this market to move a little bit higher. I have on a long TLT trade, which is based on, I think that it's a little bit oversold at this point, and I don't think that the Fed is going to start increasing interest rates anytime soon. So that should give a little room to the upside in the bonds. But today we're seeing some weakness going on there. But for the most part, 8-9 ticks, that's easily made up. Now, VIX getting a little bit of a move to the upside. Yesterday, we saw the market start to rally and giving a little bit of a push. Today, it's pretty quiet, trading relatively sideways. And is this a pause to move to the upside, or is this a rollover to the downside in equities? Well, we haven't seen any kind of confirmation there, but we can see the Dow Jones Industrial Average is off by 160 points. We were seeing quite a mixed bag here earlier on today, where the Dow was lower and we were seeing the fangs really start to push to the upside, but they're starting to weaken, as we can see here, down 20 points on the day in NASDAQ. Now, this type of chart setup is what I'm talking about, where it's kind of a pause pattern, and it would need to be confirmed whether to the upside or the downside. Are we getting like a bit of a dead cat bounce, is what we used to call it, when you get a big sell-off, a nice rally where the weaker hands will get into that market thinking they found a bottom here and continue to sell off there. Now, I've got a couple of trades that I'm looking at for the webinar today that will take advantage of a situation like this, where we're at a pause. We could implement a strategy around a pop to the upside or a sell-off to the downside, and what's the perfect strategy for that type of move. And we'll talk about that, where we can be non-directional, if you will, and still make some money. Not necessarily non-directional in being moving sideways, but just not sure of what direction these markets are going to go, but we think that there's going to be a move imminent. So we're going to be talking about a strategy that we could implement around that type of assumption today. So please check that out at protraderstrategies.com. And now it looks like everybody's in negative territory for the equities. We've got the E-mini S&Ps off by about 15 points on the day. And if we go further to drill down on this, we can see that the breakdown of the E-mini S&Ps, 30-minute candles here across the board. Coming into the day session, we made a move to the upside. I couldn't really say if the markets were really long or short with this kind of pattern. It looks like they're pretty flat, but today trying to put in the full range from the highs to the lows on the day session, which is pretty healthy. A lot of times we like to see the markets do that, and for the most part, what I was saying, it's an inside day. You can see a pretty inside day here with the points of control, where the most time and volume has been taking place over the last 2 days, is lined up quite nicely. But today what we're seeing is the value area high and the value area low is inside of yesterday's value area high and low. So that has created an inside day, and that's almost a perfect example of an inside day right there as we speak anyway. All right, so let's move on to a couple of trades that I've done. Yesterday, we were talking about BABA, and I decided to take this BABA trade off because when you're very close to your target mandate for a profit target within just 1 or 2 days, that is the really time to take that money off the table. And I got the volatility crush, got the directionality wrong. Remember, what I was doing in here with BABA was going in and I had sold the October 330 calls in there, right around $2.78. Now, I had good price location, 330, that's pretty high. Market, on what was that? We're talking Tuesday here. The market really, when I sold these calls, was really selling off, and late in the day it rallied. So literally the market was going against me. And I talked about this yesterday. I got the volatility crush, almost 7-8 points in volatility coming out of those premiums. That superseded dramatically. So that 7-8 points in volatility was right around $1.39 coming out of that premium that I just talked about of 278. Well, the directionality being wrong, the market was rallying against me a little bit when I took these off. So that took away some of those profits. But at the end of the day, I was able to get out of these BABA calls for $1.77. So right around a dollar for a profit, and over 2 days, yeah, it wasn't quite 50% of my max profit, but I only gave up about 30 cents. Today, the market, you can see volatility has kind of gone sideways, maybe a little bit down, but for the most part, it is unchanged from where I got out of this trade. And if I go and look at BABA right now, just to see where the pricing is on these 330 calls, it's probably very close to where I ended up getting out, and it's trading 165, 177, so very close to where I got out, maybe slightly lower than that now at this point. Probably could get out for about 165. So I gave up 10 cents, but at the end of the day, do I want the penny or the trade? Well, yesterday I didn't want to take any chances on a move to the upside. We were seeing a lot of things with opening up of flights from China and other countries and things of that nature. So I was a little bit worried about some upside pop based on that, and just decided to pull the ripcord on it. So yesterday out of BABA, but with that being said, if you're in a BABA trade similar to what I did, you can probably get out of that at this point. Now, Apple, I did get into this probably a little bit early, as we're starting to see the NASDAQ come off since I put this trade on. And in Apple, I played this to the upside because I figured I liked around the 100 mark. I think that's going to be a place where the market defends that. So I went in and sold the October, sold the 100 puts in there, and I collected $1.49. So my break even on that trade is $98.50. So you can see, I think that psychological level of 100 is going to be defended, and it lines up with some support and resistance areas right here. So coming down to that psychological level, especially because people just love to buy Apple, I'd be happy to get into this trade somewhere around 100 for a long position in Apple. And if it doesn't, I'm more than willing to take that trade off for a nice profit. So playing Apple, playing it to the upside, you can see it is a clean month. With that being said, the volatility in here for Apple, implied volatility percent, when we take into account that high spike is 41, but I did some math on this and basically throwing a line in the sand here, creating my own implied volatility percent, which is what I've been doing since that massive spike from Corona. I think that we'll probably not see that kind of high again, so I kind of have drawn my line in and around there. So if I created my own implied volatility percent, it is above 50, relatively, it's up in the 60 percentile, at least when I did the math. So collecting credit on this, according to my rules. Now I'm doing this a lot now where I'm not just taking into account exactly what the highs and lows are, but we have that mathematical problem, that equation that we're using in order to find our own implied volatility percent, where you can strip out some of those extreme moves that I like to call a black swan event. And I think that was a black swan event, that we haven't seen that type of volatility in the market since 1987. So to me, that signals a black swan event. Yes, I do believe that volatility is going to be relatively elevated compared to what we saw in 2019, but I don't think that we will see those all-time highs like we saw there back in March. So kind of stripping out that extreme outlier there. So Apple short the 100 puts for $1.49. One other thing I wanted to talk about is PENN. Well, I might as well talk about this. I'm kind of jumping around here from my trading portfolio. I was going to hold off on my IRA, but we'll talk about my IRA trade here. PENN making a big move to the upside today, just kind of gapping out. Now, when I put this trade on, it had sold off to around $62. So I decided to take advantage of this big move to the upside and throw on some covered calls in there. Stay mechanical, lower my overall cost basis on this trade, and went into the October and sold the 85 calls in there for $1.36. Now, obviously, markets moved up and away from that level, and these covered calls aren't looking so great. They're in my face by about 60 cents at this point. But If the market rallies up there and trades around $85, I really can't shake a stick at it because I am long this trade at $4.49. So that was a huge move in this particular stock, and most of this move today is based on the fact that we've got football coming out today. Thursday night football is going to be played. There's a lot of people just really itching to gamble on games. PENN is invested in Barstool. Now Barstool has their platform for gaming. It is going to be released in Pennsylvania only. Only people in Pennsylvania can play on it. So yeah, there is a lot of excitement around Barstool right now, but they only have one state that they can take advantage of at this point. So and they're not necessarily in Macau, which is one of the biggest gambling. I think it's taken over Las Vegas, so they don't have exposure there. So that could limit some of their upside. Right now, it is, I believe, some of the weaker hands. So we start seeing some correction in here, cover that gap. I'll be able to cover these covered calls for a nice little profit, lower my overall cost basis on that. So I'll even have a synthetic trade in PENN Gaming by lower than maybe $4 if I'm able to trade out of this for 50% of max profit, or even just a couple of pennies. I can lower my overall cost basis on this trade. I'm going to try and do this where I can get PENN for free, where I can lower my overall cost basis where I paid $4.49 to lower that cost basis to zero. That would be the perfect scenario. But at this point in time, just trying to do some covered calls, take advantage of some of this move to the upside. $85, I just have to take something off the table there if it happens. And if we get a correction there, I just lower my overall cost basis, lower my risk parameter in this trade quite nicely. And then finally, XLT is XLK actually is the trade that I added in my regular portfolio. So jumping back to my regular portfolio here, tried to take advantage of some high implied volatility. Again, kind of stripping out that extreme outlier. That puts my implied volatility percent above the levels that I'm looking at, that we talk about in the daily market or in my webinars. So check that out. How we figure out where implied volatility is right now, in and around 39.40, how that is in relation to where we've seen in the past, and that determines what our strategy is going to be, or at least narrows it down to selling some options, right? So I'm playing this to the upside, and XLK decided to go into the October and sold the 102 puts in there for $1.25. Now, why did I pick that strike location? Well, it lines up quite nicely. If we're talking about 102, that is way down here around the value area high. 102 is actually just slightly below that. My break even then is very close to 175. So that is a, yes, 175. So that puts my break even right around here. I think that's quite a big drop that I don't think we're going to see, especially for the tech sector. Yeah, we might see some correction, but at the end of the day, if we get a correction down to this level, again, that's a place that I wouldn't mind getting involved in XLK for a long position if somebody happened to put that to me. Now, caveat here, I didn't do this as a full tranche. I did it as about a half a tranche. So not putting a major stake in there. I don't want to increase my deltas too dramatically in there. Right now, I'm about delta neutral in my portfolio, which is making me pretty happy because, you know, like I talked about today in the webinar, what we're going to be talking about is a strategy where we don't know if we're going to pop to the upside or pop to the downside. So I've got a strategy that we're going to take advantage of that type of market situation where we're really kind of unsure as to, is the shoe ready to drop or are we ready to pop? All right. And that's what I want to take advantage of with this type of trade. So I've got a couple of stocks out there that we're going to look at and some ETFs to take advantage of that type of market assumption where we just don't really know, but we feel like something is about to happen and we can take advantage of that. So please go to protraderstrategies.com, check that out because it's setting up quite nicely for this strategy as today works itself out. All right, so that's all I got for you guys. Other than please check out our disclaimer. Yes, we have a disclaimer here and we want to talk about what the risks are involved in trading and in options. We are an educational company. I'm not trying to get you guys to jump on board with me with my trades. As we showed in BABA, I can be directionally wrong, so that's not always the best thing. But what we do have here is increasing your probabilities of success with these strategies. So that is what is important, because like with BABA, despite the fact that I was directionally wrong, we made some money on that, a nice profit in just a matter of days, because I set these strategies up with the right environment, the right duration. All of those things coming together will a lot of times supersede a bad directional assumption. So what we're going to try and do is talk about that today in the webinar, and hopefully you can take advantage of some of these trades in your portfolio, but please implement them into your portfolio in your own way is the bottom line. All right, so if you can't take that, take it easy.